Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Duggal. Let's get to the headlines this afternoon. Indian markets slide as Punjab National Bank leads financial stocks lower. The lender's own stock cracks after it discloses a larger hit on account of the Nirav Modi fraud.
The Finance Ministry sets a 15-day deadline for PSU banks to identify the gaps in the system and make suggestions on how to plug them.
Nirav Modi's US-based firm Firestar Diamond Inc. files for bankruptcy in New York.
And Ambuja Cement is the worst performer on the Nifty after it puts its merger plans with ACC on hold.
Right, lots of developments in the Nirav Modi PNB fraud case. But before we get to that, let's dip in and see how the markets are doing. About 1/3% lower on the Sensex and Nifty. Neeraj is with us for a check on the markets. Afternoon, Neeraj.
Hey, afternoon, guys. And hey, I was wondering if the sell-on rally template we were talking about in the morning, whether it'll come back to bite. I don't know if really that's the reason, but banks have provided that reason. So there's some bit of profit booking that we're seeing in the session today, for sure, even if it's not a sell-on rally. India VIX ever so marginally, but has gone up a little bit in the session today. The respite is, though, that the broader market breadth hasn't really cracked. I was looking at the BSE 500. The advanced decline ratio on the BSE 500 is about 1:1. So the broader markets aren't doing all that poorly, which is actually a good thing. But banks have taken a bit of a backseat today. 4 or 5 straight days of gains. Today, the private banks have come off. That's leading the Nifty bank lower. As much as we want to think that the PSU banks are the culprits, but the real reason are the heavyweight private banks. Not to say that the PSU banks are not doing great. So, I mean, because of PNB or otherwise, all of these banks, Union Bank down 5, BOI 4%, Canara Bank 3.5%, SBI is about 1.5%, but PNB, of course, has cracked viciously. Now it's sub 100 and down about 10.5%. So all those theories about bottom buying, because all the mess about PNB is known is out of the window. Anybody who bought it yesterday or days before has now a 10% hole in his pocket. So that's one more thing. And I think a clutch of names which are very active yesterday also have seen some bit of profit booking there. So the likes of Oberoi, Chambal, etc. By and large, seems to be a day wherein people have booked a little bit of profit in the session today. A couple of names may have done well, but by and large, it's a day of profit booking.
Neeraj, I mean, we'll do a deep dive into the PNB stock charts with Jayesh in a minute, but I think the point you were making in the morning was an important one. They said 280 million, market said, okay, we believe you. Then they said 1.7 billion, market said, okay, we believe you. And now they've come up with another 200 million. So where does this stop? And that's a valid question that investors may be asking.
Yeah, and now markets will believe that, okay, now they've said this. Even if they come out with something more, we'll probably not believe that because you don't know how deep would the rod be running. And it's a valid question to ask, I would presume. Any investor should ask that, if not already.
Thanks, Neeraj.
All right, let's move on. Now, the government has meanwhile set a 15-day deadline for public sector banks to identify gaps and suggest a comprehensive strategy to strengthen operational and technical processes. The Banking Secretary, Rajiv Kumar, has put out a tweet saying senior functionaries will be held accountable for any lapses. Nikunj Ori now joins us from Delhi. That's quite a strong message out there, Nikunj.
Right. The Finance Ministry has given a 15-day deadline to public sector banks to identify gaps, technological and operational risks in the system and take preemptive action. The Financial Services Secretary, Mr. Rajiv Kumar, tweeted there would be a group of executive directors and chief technological officer who would be tasked to identify gaps in the system, make a comparative assessment of operational risk management practices of their respective banks with the best in the industry, and based on the report submitted by the group of executive directors and chief technological officer, the board of respective banks will assign accountability to senior authorities who would have to make sure that these recommendations given by the group of EDs and CTO are implemented. Over to you.
All right, Nikunj, thanks so much. So sort of trying to move and contain operational risk in these banks. It's coming a little bit too late in the case of Punjab National Bank, where the stock has corrected sharply since this fraud was disclosed. Jayesh is joining us with the story of PNB in 4 charts. Jayesh.
So here we are looking at some of the charts that we have from the Bloomberg terminal. So what I did was 4 charts depending on 4 time frames that we have. Let's start with the daily time frame. What you have on the chart is a 5-year daily movement. The red and the green lines show you the candles, and the white dotted line is essentially the 200-day moving average. What you can see currently is that it's trading sharply below the 200 DMA. To give you an exact number, that's 35% lower. Let's have a look at historically how this has panned out. So in 2014, 15 and early part of 16, the stock actually traded below the 200-day moving average, and it took good more than 1.5 years to recover and climb back. The same case happened in 2013, and just before that, when you saw that the entire year of 2013 that was spent below the 200-day moving average. And currently we have just broken below. Just about a few days back, this has broken below. So if history is to go by, could be a consolidation or a further downfall for more than years to come, and then we could see a climb back. Let's have a look at how the weekly chart pans out for Punjab National Bank. That's the interesting one. So this is a weekly chart starting from 2013. Let's focus on the double top pattern first. So in 2014, this point was 231.5, and the recent high was 231.6, just 10 paisa higher than what the previous top was. So the double top has been formed, and post that the stock has declined. Where could it find a bottom? Now first we analyzed where was the low of this particular trend, which started in 2016, this yellow line. So now this has been broken. This was about 130 odd level. The next yellow line was the next bottom that had been formed in 2016. That has been broken as well. The next future support that we could look for is the double bottom that was formed below 80 levels for the stock, currently at about 99.5. So that's where the double bottom forms, and that could act as a support for the stock. Moving on for the monthly chart that we have, so I used the Fibonacci retracement tool on the Bloomberg terminal, and it shows that so what I did was only consider what the recent leg, the rally has been, starting from 2016 to the recent high. If I draw a Fibonacci retracement over there, the 61.8%, which is a key support level for the retracement, that has been broken, and the next support that comes at about 69.25. So some of the key levels that you have to watch out for. So that's about the technicals, but how do the fundamentals, or the key valuation parameter that one tracks for Punjab National Bank is the price to book. If we can have the chart on the screen, you'll see that. So the white line is the actual price to book, and the blue line is the estimated 1 year forward price to book. What it currently does is it shows that the price to book is lower than the estimate, which means that the stock is available at an expensive valuation 1 year forward. So some of the technicals and fundamentals put together for the stock of Punjab National Bank.
Yes, thank you so much for that interesting analysis. That meanwhile, Nirav Modi's international jewelry business Firestar Diamond Inc. has filed for bankruptcy in the United States. The jeweler blamed liquidity and supply chain challenges for this move. Jeanette Rodrigues from Bloomberg News now joins us. Jeanette, so this claim has nothing to do with what's going on here in India. There's been not even a reference to it.
No, Firestar was actually not named in this complaint to the CBI by Punjab National Bank. Of course, this is a company that's affiliated with Nirav Modi. According to media reports, Nirav Modi had written to Punjab National Bank saying Firestar could be one source of funds which would help repay the money to PNB. Of course, that's now not even something being discussed. So Firestar, while it's not directly implicated in this scam, we do have to consider it as a source of funds for the group, and definitely creditors should be concerned. Another question we need to ask is, do the same banks that have exposure to the PNB fraud, do they also have exposure to Firestar? That's a question that we still have to delve into. We have asked the banks that question, and none of them have come back to us and given us clarity on that yet. How much debt is this company claiming in its Chapter 11? Firestar says that it has assets worth up to $100 million, but it also has debt of equivalent amounts. It says roughly 50 to 99 creditors are exposed to this company. So these are the financials which they have disclosed, but the names are uncertain, the precise amounts are uncertain.
All right, Janet, thanks so much. That's Firestar, and that's one of the promoter companies of the Nirav Modi Group. But the impact of this entire story is playing out on the broader gems and jewelry industry as well. And Swansea is joining us to give us a sense of what some of these jewelry companies are facing. Remember, this is not the first time that this sector has found itself in trouble. Although in previous cases, it was credit risk. This time, it's a different kind of risk that has played out.
Right. I mean, jewelers are fearing that, this fallout of this Nirav Modi case, plus, in the past we had Vincent Diamonds also defaulting. So these kind of things will further tighten credit to the sector, and these fears kind of are seeming to be true, because in the past 2 weeks our sources are saying that, banks are kind of being very serious and they're checking jewelers' accounts again and asking for, ensuring that they only give loan to genuine exporters and not round trippers. And at the same time, increased scrutiny and documentation. And we have anecdotal evidence of that, they are questioning even in charges of like...
Where there's increased scrutiny?
Yes, scrutiny, yeah. They are questioning charges like for even 180 rupees, which is a very small...
Yeah. So are financing options drying up for these guys?
Yes, they are in a way. Like, we haven't yet heard from on the ground people saying, but from the banking sources we are saying that they are being very strict about who they lend to. So that would mean they will have lesser credit, and that would kind of impact exporters, because their productions will fall, and that could ultimately impact jobs. That is what the industry is fearing. Okay.
Swansea, thank you for joining us with those details. Let's get in an industry perspective now. Colin Shah, Vice-Chairman at Gems and Jewelry Export Promotion Council, now joins us on the phone line. Mr. Colin, thank you so much indeed for joining us. My colleague was just referring to how there is a certain sense of nervousness in the industry. Funding options are drying up, banks are increasing scrutiny. What's going on?
Banks are increasing their scrutiny. That's happening for sure. It's a pity this has happened. GJPC is 50 years old. We have 6,000 members. In those 6,000 members, 2,500 are exporters. And while this incident has happened, these are 2 out of 2,500. So we really hope this is not a reflection on the industry at large. But I'm sure in the short term, bankers are going to scrutinize, everyone with a magnifying glass. So SMEs continue to struggle for finance, and I mean, this incident has happened. But to be honest with you, this incident is also a large lapse on the part of, this particular bank, Punjab National Bank, and this is in no way a reflection on the industry at large. This is 2 particular players, 1 bank, a scam in that sense has happened, but it's not the industry at large.
Mr. Shah, in particular, are financiers becoming are not doing LOU-based financing anymore? Are they looking at direct credit lines instead? Can you give us a sense of that instrument? Because I believe it was quite prevalent and widely used in the jewelry industry.
No, this actually is a misnomer, and let me be the first one to correct you. Diamond imports has been happening in this country for nearly 50 years. And as you know, 14 out of 15 diamonds are cut and polished in India. LOU is actually not used as an instrument at all by the industry. This is a super rare instance of 2 companies doing this with Punjab National Bank. So even if the LOU instrument is, say, discontinued, it will have no impact on the industry because nobody was using it, and we as GJPC have not only, been in touch with the government about this, we've been in touch with the bankers also. So it's a little mind-boggling even for us as to why this instrument was used in the first place in this particular case.
Okay.
So it's not used prevalently. I mean, let me clarify this very clearly.
But sir, I mean, in the initial phases, this was an instrument used widely by capital goods companies. And then I think, regulations were changed, etc. And then...
Yeah, the diamond bank merchants never use this, so...
Are you sure that's true, sir?
Yeah, I'm absolutely sure.
Okay.
Okay. While I understand, Mr. Shah, that this is not an industry-wide issue, we've seen the Winsome case and now the Nirav Modi case. What's the mood in the industry, and is there conversations on self-regulation? Give us a sense of what's going on.
See, the mood in the industry is grim. Since 50 years. Okay, this is probably like say the darkest week, I would say, if I can say so, in in the industry's history, where even if you walk on the roads or anywhere and you say you're a jeweler, they're looking at you as if you're some kind of thief who has cheated the country, which is absolutely not the truth. It's these two people who have done this. I wouldn't say it's the industry at large. I can only assure everyone that it's a very ethical industry. On the contrary, like just to give you broad level numbers, our exports are 1 lakh crores. The total debt of the industry is 50,000 crores, at last count. And out of that, you have this huge number. So if you look at, say, the remaining 2,500 of us, we don't use that kind of finance in proportion to our exports. So, it's actually contrarian, but now this incident has happened, and I guess, our generation will have to bear the brunt of it.
Mr. Shah, I guess the impact immediately will fall more on the SMEs, as you were mentioning. The larger guys probably have some cash sustainability, probably have other means that they can use. Is there any hand-holding that can be done for the SME sector? I mean, I'm not sure who will do it, because the government and the RBI will probably not be in a position or willing to make concessions for the industry at this stage.
Hand-holding will happen, but we as Gem and Jewelry Export Promotion Council, we are making our best efforts to meet bankers, meet the concerned officials in the government, do our best to calm everyone's nerves that let's look at the business. It's fundamentally strong. It still makes profits. They repay their debts back, and good promoters should continue to get money.
Okay.
So that's all that we can do, I guess, at this point. I think time is a healer. So.
Okay. Mr. Shah, there's another issue that has cropped up, which is getting attention, although no explanation. I think the Economic Times has reported this, and since then, chatter around it has been fairly loud. The fact that imports of cut or polished diamonds in the current financial year have surged almost fourfold. Can you help us understand why that would have happened, sir?
Yeah, so I can, I can very clearly say over here that this is very incorrect reporting, to say the least. The import figures actually are down 15% compared to last year. At exact count, we are $1.5 billion. So it's actually a decline of 15% compared to the same period, April to November last year. What it shows is, and why there was a discrepancy in the number, is goods which go on consignment, where we all do exhibitions globally. And when we send goods on consignment abroad, and then they come back, in a period of between 1 month to 3 months. So those particular imports which came back last year have had an impact on the number, but it is not to the extent which has been reported. Imports of cut and polished diamonds are actually down 15%. So even we,
Sir, and I assume that these, these trade kind of shows happen regularly. Is there a reason that last year would have been more than this year? And this is official data.
No, but I can, give you government data actually on this. This was an error. I think it's just, I guess the entire frenzy of the last 2 weeks and, all kinds of things being reported on the industry. I mean, this data, imports are actually 15% down, which I'm happy to, share with you.
Okay.
It's government import data, so it's not like, data made by us or anything of that sort.
Okay. What's been the near-term impact both on demand and volumes, export volumes, I mean, in the last couple of weeks?
In the last couple of weeks, there's been no impact on demand. Actually, markets are healthier, and that's why this has come as a bit of a shock to all of us in the industry. Markets have been healthier in 2018 than 17. Our major consumer markets are, as you know, it's the US and then China, followed by Europe, Japan, and the Gulf region. And most of the large economies in the world are actually, doing phenomenally well. So when US, you have the Dow at all-time high, you have an unemployment at all-time low. With the tax cuts over there, the mood is good. So actually, for the diamonds and jewelry industry, the jewelry industry at large, 2018 will be a nice growth year. So this is just a blip, I would say, on the macro level business scenario. I mean, obviously, sentiment in India is very low, and I guess, but I don't see this as having an impact on the demands for gems and jewelry.
All right, Mr. Shah, we'll leave it there. That's the industry perspective on this whole story playing out, the impact on the gems and jewelry sector. Mr. Shah believes it's largely a sentiment impact. Let's move on. Even as the liquor industry grapples with regulatory issues and a high tax burden, United Breweries is confident of keeping the growth strong. In a conversation with Bloomberg Quint earlier today, the company's MD Shekhar Ramamurthy spoke of rebalancing volume and value in the quest for growth. He insists that while someone in the industry will lose market share, it will not be United Breweries. Listen in.
Now, the reality is that in our country, alcoholic beverages are part of the state subject, and we are subject to increases or changes in excise duties, taxes, state by state practically every year. So yes, to that extent, the industry is, if I may say so, accustomed to it. And small, moderate increases do tend to get absorbed by the consumers, and we do see not much of a change in consumer behavior. However, in the last few months, we have seen a proposal for a very steep hike in duty in Maharashtra, because of which, as you mentioned, for about 2.5 months, we were not able to manufacture beer in Maharashtra because we were in dialogue with the government to have this duty hike corrected, which they did. There was a duty hike. Prices did go up by about 10%, but it was not as much as they had initially announced, which would have taken the prices up by almost 40%. Similarly, as we speak, there is a very steep excise duty hike proposal in Bengal. Again, for about 6 weeks now, we're in dialogue with the government of Bengal, and we are hopeful that this excise duty hike would be moderated. As of now, if it were to go through as it is, the price hike in beer in Bengal would be 40%, which is pretty steep. So we are hopeful, but that will get addressed. But as of now, it is still a little bit of a stalemate. So yes, duty hikes do go up. The recent Karnataka duty hike was on hard liquor, not on beer per se. And as it is from the beer industry perspective, we believe beer is extremely highly taxed. It's perhaps the highest tax category of alcoholic beverages. In most parts of the world, alcohol is taxed on alcohol content, whereas in India it tends to be on value or volume. So the per unit of alcohol duties and taxes on beer in India are far higher than on hard liquor. So in sum, yes, if the duty hikes are moderate, they tend to get absorbed by the market and the consumer. And 10 years is a long period of time, yes. If you look back 10 years too, similar hikes have been there. But in the short run, yes, there would be impact, whilst long-term consumers get used to it.
Conversations with some of the smaller companies, we've had a few conversations with the companies which are not your size, but all of them are talking about, one, the growth being there, two, they're seeing growth by increasing of their market share too. I mean, the conversation always is that the market share for those companies is so low that there is a heightened possibility of their market shares moving up. Now, my question is, over the next 2.5, 3 years period, within the space that you operate in, what do you think will happen? Will giants like yourself, maybe Carlsberg, increase the dominance and increase the market share? Or do you think the smaller companies, because all of them are revving up with better personnel, increasing their logistics and distributions, will take off some of the market share? So the pie may grow by and large, but the share distribution will change a bit.
See, this is a competitive industry.
Yes,
and
it is. All are. Yes.
There are more and more new players coming in, some large, some small. And as a market leader, we genuinely respect all our competitors. And we recognize that they're here to be successful and to meet their objectives. Now, if you talk to any of us, whether you talk to United Breweries Limited or any of our peers in the business, they will all say to you that they're here to grow their business and grow their shares. Now, the question that arises is, will that share gain come at the expense of market leaders like us, or will the share gain come from at the expense of other players in the business? Now, as UBL, we have demonstrated over a period of time that notwithstanding other players coming into the market and big multinationals coming into the market, we have constantly held / increased our shares. Over the last 12 months, our share has gone up by about 1.5–2%. So yes, there will be more competition, and there will be a different kind of competition because you're seeing smaller players, niche players who are carving out for themselves a new segment in the industry, and it becomes our responsibility to respond to that because clearly they have opened up new consumer opportunities, which perhaps the bigger players were not addressing. But having seen that happen, now it is our responsibility to respond to that, and we will. And you will see that our portfolio brands will also offer offerings and brands which will cater to these emerging consumer segments.
No, the reason I asked this question to you, Shekhar, was that it can't happen that everybody believes that their market share will grow up by 400–500 basis points. I mean, somebody has to lose. So whether the organized players, small and large, gain share at the cost of the spurious and the unorganized ones, or is it that the smaller but organized players take some sheen off the larger ones, which is the essence of my question, really?
Well, only time will tell.
Okay.
Only time. But I can say that our objective over the next 2 to 3 years to add further market share, and it'll clearly come. I mean, this is arithmetic. Cumulative market shares cannot be more than 100. So somebody will have to shed some share, and it will not be us.
Okay, that's UB for you. Coming up next on the show, ACC and Ambuja put their merger on hold. We'll tell you more on that story on the other side.
Bado, bado, bado mere sang.
कुछ इसी तरह बच्चों के साथ साथ बढ़ते हैं LIC के चिल्ड्रंस प्लान्स, जो दे आकर्षक भुगतान बच्चों की हर बढ़ती अवस्था में।
बढ़ो 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 मेरे संग।
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार, just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Merge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
On 26 November 1949, the Constitution of India was adopted, recognizing liberty, equality, and fraternity as the principles of life, which cannot be separated from each other. The government of Karnataka has imbibed the ethos of the Constitution by developing programs and policies aimed at creating a socially, economically, and politically just society. Karnataka's flagship programs such as Maitri, Annabhagya, and Arivu have created an equal opportunity platform for all, irrespective of their gender, economic, or social status. Karnataka is committed to encourage education through various welfare initiatives, ensuring equal status for women and empowering minorities to uphold every individual's dignity. In the last 4 years, Karnataka has formed 462 new Gram Panchayats, which has taken the principles of democracy to the grassroots levels, and our Progressive Vision 2025 document engages public government participation to build a better state for all. Karnataka's collective vision to endorse fraternity, justice, and equality has transformed into Karnataka's model of development, which is based on the tenets of the Constitution.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Welcome back. You're watching Power Lunch. Let's take a look at the headlines. Indian markets continue to struggle as banks and real estate stocks trend lower.
Monnet Ispat's creditors may have approved JSW Capital's bids for the company despite having taken a 70% cut on their outstanding amount. That's an exclusive.
Ambuja Cement is the top Nifty loser after the cement maker puts its merger plans with ACC on hold.
A search committee constituted to choose the next IRDAI chairman will meet on the 5th of March.
All right, first look at the markets. Slight pairing off of losses, so markets are still down, but just about a tenth of a percent. Agam Vakil joining us with what's moving within the market. Agam, afternoon.
Good afternoon, Hira. Well, consolidation continues for the benchmark indices. Nifty holding on to 10,500 for now. And what we're also looking at is cash turnovers, largely average, nothing much to speak for. On the other hand, we've seen once again when it comes to the NSE F&O turnovers, well, largely below average, at least in terms of the previous 7-day averages, if you consider that. Broader markets also falling largely in line with the benchmark indices, with the mid-cap and the small-cap indices also looking at marginal cuts for now. The mid-cap 100 is looking at a slightly deeper gash, but again, it's not significant. So what really stands out, of course, is the PSU stocks, once again, led by Punjab National Bank, and a lot of weakness in several other counters such as Allahabad Bank or Canara Bank or Oriental Bank of Commerce, Union Bank. There you have it. So, of course, looking at weakness of well over 3 to 5%. On the gaining end, we are looking at some amount of stability when it comes to the auto index or the FMCG index. And in the top Nifty gainers, we have Dr. Reddy's and Hero MotoCorp. On the losing end, we have something like an Ambuja Cement, of course, reacting on the news that it has kept its merger with ACC on hold. But on the whole, consolidation continues for the benchmark indices.
Agam, thank you for that. Let's talk about earnings. Majority of the Nifty 50 companies met estimates in the third quarter, hinting at the possibility of an earnings revival. But how does it translate to earnings per share in fiscal 18? We at Bloomberg Quint have done the math to try and arrive at an estimate based on the various brokerage house reports. Jayesh is standing by with some of those findings.
The Nifty EPS is likely to be on a path to recovery. Now, based on the math that we have done, let's have a look at what we have done so far in the 9 months ended December 2017. So we've already done 362.4 as EPS. Now, based on the Bloomberg estimates available for the net profit of all the 50 companies, what we are expected to do in Q4 FY18 is 142 rupees. Now, in case this 142 rupees comes out as the EPS for the fourth quarter of fiscal 18, what will be the growth rate, the implied growth rates? Let's have a look at that as well. So year on year, it is estimated to grow at about 27%, and on a quarter-on-quarter basis, a growth of about 9.4%. Now, let's have a look at some of the scenarios that we have done. So FY18, what we have calculated, the 362.4 plus the 142, that will give you a number of about 504.4. So, that will imply a growth of nearly 21% as compared to FY17. Now, let's have a look at, consider some of the brokerage reports that we have got. And this is based on the consensus of 5 reports that we got. So, the, estimate for FY18 came out to be about 417. In case this number comes about, then the year-on-year growth, the implied growth would be about 12.7%. Let's have a look at further, FY19 estimates are also available. So FY18, if we take the base case scenario of the brokerage reports that we have got, the EPS is likely to be 470. And based on those 5 reports as well, the FY19 EPS, that is likely to come in at about 577. which gives it a growth of about 23%. Now, where does this 23% stack up in history? Let's have a look at that as well. So that from FY11 to FY19, so FY19 we are expecting, or the brokerages are expecting 23% growth. The last time such a big number was seen was in FY11, where we got 27.5% as the EPS growth. But does the actual EPS meet what the estimates are there on the street? Let's have a look at that trend as well. So generally what happens, so on this chart what you see is the white line is the Nifty EPS estimate, whereas the yellow line is the actual EPS. What generally happens is analysts tend to estimate on the higher side. So the spike that you see for each year, that is April the 1st, and you see that generally they start at the high point, and towards the end of the year they tend to revise their estimates downward. That is what has exactly happened in this year as well. So we started off way above at about 540, and currently we are at about 500. And you can see that previous instances also, this was a decline of about 10 odd percent. FY16 that saw a cut of about 21%. The other thing to note over here is that the yellow line has never crossed above the white line, which means that analyst estimates have never been met. But in this case, what we saw previously, in that case likely that Nifty will break this trend and the actual EPS will come in more than what is anticipated for FY18.
All right, thanks so much for that, Jayesh. Interesting analysis there. He's looking at the numbers that have been reported by analysts in terms of expectations, and these are not Bloomberg Quint's own expectations. Earnings, of course, key, but UBS also believes that the markets have their eyes trained on elections. According to a recent report by Gautam Chichoria, the markets have factored in a win for the BJP in 2019 Lok Sabha elections. Any different outcome would have them running for cover. We caught up with Gautam a little bit earlier today. Listen into a bit of that conversation.
If you talk to investors globally and in India, I think nearly all investors with a very high degree of probability assume and presume that Mr. Modi's government is going to come back and probably with the majority. So in a way, the markets are pricing in continuation of the current government and therefore the policy framework. And that's what's being reflected in the rich multiples and the confidence market has.
What have you guys been doing when it comes to these conversations? Because I'm sure there is a set of investors who believe that it's more or less a given, but would be wanting finer details about what could happen, what could be the math, what could the math be. There is an impact on the lower house and the upper house as well. And there's, as I said, a clutch of smaller elections that make an impact on the mood, if not the overall election outcome.
Absolutely. So again, we're not in a position to forecast what will happen. Even exit polls go wrong. Forget opinion polls and forget our views. So what we tell investors is to look at the pointers ahead over the next 1 year. And the pointers, as you said, are various state elections. Possibly even opinion polls. We might see opinion polls happening middle of the year, specifically if talks around the national elections being preponed to late this year starts happening. So if that happens, we'll also have opinion polls even for the full country sometime this year. And what we tell our clients and investors is that one of the key things to track from an analytical perspective is whether the fragmented opposition starts uniting, because behind the narrative of the popularity of Mr. Modi now and in 14 is also electoral arithmetic. If the opposition starts uniting, then that could also have a bearing on the outcome of elections.
Okay. I have one question from market's perspective, Gautam. And I think you make a valid point, and probably a no-brainer of sorts, that a change in expectations of what happens in the 2019 elections could have an impact on the market multiples as well. And investors will probably monitor all of those very, very closely. What is... I mean, we'll know what happens in 2019 only in 2019, and let's work for a moment with the assumption that elections happen on the date that they are supposed to happen. If indeed any of the state election results throw up a result which the market doesn't want to see, and there is a high probability of some of those things happening in the state of Rajasthan, for example, but if indeed that were to happen, would that cause an immediate derailment in the market multiples, and to what extent?
So our sense is, from a state election perspective, if I talk to investors, the investor feedback suggests that the markets and investors would worry only about the state election results later in the year. Unlikely they'll worry about, say Meghalaya, etc. And even unlikely they bother much about Karnataka, for example. They will bother about the three big elections end of 2018. So that's some time away. It's a few months away. But before that, if you start seeing opinion polls happening into the year, then obviously markets will start taking cues from that.
Gautam, good morning. Ira joining the conversation. My questions are slightly more basic and, for a market audience may seem a little too simplistic, but I'm going to ask them in any case. Tell me, 4 years into this government's term, is the market convinced that this government's economic policies are any different or substantially different from the previous government's policies? And if not, then why does it matter so much who comes back?
So there are two things on that. So policy broader trajectory towards reforms. You could argue it both ways, but what we have seen definitely in the last 4 years is definitely better execution in terms of the reforms actually getting done, like GST, FDI, other stuff, and including ease of doing business. So the broader policy direction has definitely picked up pace. And second is not just policy, but even in terms of execution on the ground, like infrastructure project taking up or focus on that, that's definitely picked up pace over the last 4 years. Now we can argue whether it's picked up enough versus what India needs or versus what markets itself were expecting in 14. But there's definitely a clear pickup happening over the last 4 years. What's also happened from the market's perspective, and this is specifically true for the global investors, India's macro has improved a lot. So inflation coming down, fiscal being in control, currency being stable, that's given a lot of comfort for global investors that India, unlike in 13 where it was one of the fragile five, is now being talked about as one of the future growth hope stories. So that's definitely the big change which has happened over the last 3 to 4 years. Now you could argue how much of it is new policy, etc. But at the end of the day, those results are there to be seen.
On the first, Gautam, so what are the indicators that you all are focused on? I mean, you could look at something like stalled projects and say that there hasn't been a substantial change in that number. You could look at private investment for various reasons and say that the government has not managed to push that up despite, wanting to crowd it in by pushing forward public investment. So on the first, when you say that there is change on the ground, with the exception of GST, which is also having a fair amount of teething troubles, what indicators are you looking at?
So, for example, the pickup in road construction. So that's been one of the clear areas where we have seen a pickup by both in terms of NHAI, government, and including at the state level. So that big push has shown up in pickup in road construction. We are seeing early signs of pickup in housing activities with the government's focus on affordable housing. So again, it's not broad-based. The private capex is not just what the government does. So private capex has been a worry. And from our macro perspective, we do not expect a pickup in private capex in a hurry. So we have been underweight industrials infra. We still remain underweight. But from a broader government policy focus, there are positive areas where we have seen activity pick up over the last 3 to 4 years.
Gautam Shishoria of UBS talking about what's likely to happen in 2019 and the various permutations and combinations. Ambuja Cement, meanwhile, and ACC have put their merger plans on hold. The two companies say that there are certain constraints to the merger, which has prompted them to take this decision. Nikki Mirchandani is standing by with the details. Nikki, what's next from here, and what's the street saying?
Sure, Harsha. Just to quickly put you through the basics, that the Ambuja board has decided not to go ahead with the merger is known thing. Few constraints which have not been mentioned by the company. A special committee of directors was set up back in May 2017, which according to a feasibility study decided that they would not like to go ahead with the merger right now. Also, in other highlights, they decided to have an agreement with ACC where they would like to have a pact for purchase and sale of their services as well as products. If you look at the synergies benefit, we were expecting expecting a benefit of around 780 crore to 900 crore on the upper side, which was divided into two bits, which was the supply chain bit to an amount of 380 crore, and the synergies out of fixed cost optimization had a synergy on the upper side of 460 odd crore. Motilal on the delay said that the constraint apparently which the company is talking about could be in the form of limestone transfer charges of rupees 64 per ton. Also, it says that the pact that they've decided to enter into for sale and purchase of agreements and services with ACC could be difficult, and that the extent the stated benefit of the synergies wouldn't come through. They've not come through in the last 4 to 5 years ever since the deal has been entered, and hence they've not factored that in the estimates, which is kind of positive for the financials of the company right now. However, it also makes in a point where they say that the company now, both the individual company would be losing their market share to the players like UltraTech Cement, which has a pan-India presence, and the north-based player Shree Cement. IDBI Capital Markets says that this is expected to be a neutral to negative stand, given neutral because it's yet not been completely called off, and negative because ACC shareholders were expecting some favorable merger ratio to come out of the deal, which is clearly not happening right now. Credit Suisse on this deal says that synergies have been delayed, and obviously the sentiment remains negative on both the counters. We've seen the stock coming down lower substantially. They also have a cautious rating right now on the sector, and they say a mechanism was expected to be needed to ensure that one particular company doesn't overlap the other company, and the benefits of two could be realized completely. And they also go on to say that the development is weaker than what the market was estimating.
All right, Nikki, thanks so much for that. The JSW Aeon Capital Partners combine is the only bidder in the case of Monnet Ispat. This is one of the 12 largest stress loan accounts that were referred for insolvency last year. Sources have told Bloomberg Quint that the committee of creditors have accepted the revival plan submitted by JSW Aeon, which proposes to pump in about 3,700 crore into the company. Payaswani Upadhyay is here with us with the BQ exclusive details. Payaswani.
Sure. So you mentioned the big number, Ira, which is the 3,700 crore rupees. The liquidation value of the company in the resolution plan was pegged at 2,365 crore rupees. Now, here's how this 3,700 crore fund will be used. The proposal is at this stage to pay 2,650 crores to the financial creditors. Their admitted claim was a little over 10,000 crores. So essentially, the financial creditors are taking a 76% haircut if these amounts get finalized. The remaining 1,055 crore will be allocated towards capital expenditure, working capital and transaction related expenses. Notably, the operational creditors, they had the accepted claim of 443 crores, but they are set to get nothing if this proposal is accepted in this shape and form by the committee of creditors. Here's how the JSW Aeon Capital Consortium aims to fund this 3,700 crore rupees. They're going to take loans from banks to the tune of 2,500 crore rupees. There will be a working capital advance by JSW Steel of 125 crores. There will be funding by bidders in the form of equity and quasi-equity to the tune of 875 crore rupees. And there will be, again, the consortium will also additionally, infuse debt or equity at a later stage of 200 crore rupees. It will be interesting to look at this 875 crore rupees of equity and quasi-equity that is being infused. It includes 398 crores as equity, 277 crore via compulsorily convertible preference shares, and 200 crores in the form of quasi-equity, and this will acquire the optionally convertible preference shares that are currently sitting with the existing lenders. If this resolution plan gets implemented in its current shape and form, as we learn from our sources, here's how it will impact the shareholding structure. At the end of it, JSW and Aeon will hold 75% stake in the company. Lenders, which are currently at 50% thereabouts, will hold 18.75%, and the promoters' shareholding will be reduced to 3.16% from the current shareholding of 25%. The plan also, the resolution plan also proposes some transfer of Monnet Ispat's non-core assets, and these assets could potentially then be transferred to a new company, which the plan is to be sold at a later stage at fair market value. Some of the potential names for these assets could be the company's Raipur unit, the Hahadi iron ore mine, investment in Orissa Sponge Iron and Steel, which is currently pledged that investment with lenders. Their coal washery at Patardi and Angul will also be potentially transferred to this new company. The Gayatra and Guma Posuri limestone mine in Chhattisgarh, that is proposed to be continued for the benefit of JSW Aeon Consortium. What we learn at this stage is this is a plan that is accepted by the COC. The COC will vet with its lawyers the plan for from a variety of legal angles, and that could take about 2 weeks. So the plan is about at least 2 weeks away from the approval stage.
Interesting. Thanks for that exhaustive report. Thank you, Payaswini. IRDAI, meanwhile, may get a new head this month. Sources have told Bloomberg Quinn the research committee appointed to nominate the next insurance regulator will interview candidates on the 5th of March. The top post is currently vacant after T.S. Vijayan retired on the 20th of February. Riddhima is standing by with more details on the story. Who's been shortlisted and what happens next?
For the new chairman for the Insurance Regulatory and Development Authority of India looks like it's finally coming to a close. We understand from 2 official sources close to the development that the shortlisted candidates will be called for the final interview on March 5 by the Financial Sector Regulatory Authority, which also takes care of all the financial sector appointments and is headed by the Cabinet Secretary P.K. Sinha. So these interviews will be scheduled on March 5, and we understand from the sources that the final recommendation is also likely to go in the same week. Up to March 10th, the recommendation will be sent to the Cabinet, and the Ministry of Finance will then take up to 2 weeks to finally decide who the new chairman of IRDAI would be. So we have got a list of 8 candidates who have been shortlisted for the interview. First one of them is Nilesh Sathe, who is the member Life of IRDAI. V.K. Sharma, who's chairman of Life Insurance Corporation of India, is second. The 3 managing directors of LIC, B. Venugopal, Sunita Sharma and Hemant Bhargava, are also contending for the chairman position. Along with them are the chairman and managing directors of New India Assurance and National Assurance. Apart from these, we've also got a confirmation from the former chief secretary of Karnataka, Subhash Chandra, who has also said that he has also been called for the March 5 interview. So the delay in the IRDAI appointments, yes.
All right, Riddhima, thank you so much. I know you're tracking the story closely. We will come to you as soon as there is a decision. 5th March is the next date to watch. Let's move away from the listed space into a segment which generated a lot of buzz. Financial technology startups, they had set out to disrupt the world of finance. However, somewhere along the way, they have become more collaborators than disruptors. That's one of the interesting takeaways from a Capgemini LinkedIn report on the global world of fintech. These companies face a number of challenges in trying to gain scale, including things like access to capital and, of course, brand recognition. Let's get more perspective on this report that has been put out by Capgemini and LinkedIn. Joined now by Anuj Agarwal, Director at Capgemini at the Financial Services Strategic Business Unit there. Anuj, thanks so much for taking the time to speak to us. It was interesting to me. We sat through many panel discussions here in Mumbai where, the battle was between the incumbents and the fintech companies, and the talk was that they're going to be disruptors. I think 2-3 years down the line, reality is that they may not be disruptors. They may just add to the overall financial services sector and bring in some interesting products, competencies, processes.
So, yeah, thanks a lot for having me over. So to answer your question, I would say it's yes and no. I think fintechs are really going to be responsible for bringing in a lot of the disruption that we are going to see over in the financial services space over the next few years. But you are right in the sense that I think till a couple of years back, there was a lot of talk about how fintechs might, pose a really big threat to incumbents, or how they may end up eating the lunch of incumbents in a very short period of time. And I think the reality is now setting in that each entity really needs the other more than ever. Both of them bring a very symbiotic set of advantages to the table, and it's increasingly becoming very clear that the challenges of one are really the benefits of the other, and hence collaboration between the two is really the name of the new game.
Okay. What to your mind, Anuj, are the challenges faced by fintech companies for scaling? What is restricting them from growing as fast as expected?
Sure. So I think there are a couple of different primary factors. First and foremost, unfortunately, they don't have the economies of scale right now. So there is a bit of a chicken and egg situation with regards to having the customer base you really need in place to be able to scale up at a rapid pace. And that is one area where collaborating with incumbents can really help them. The other disadvantage they often face is the lack of capital, which again, some of the stronger brand names, when you collaborate with them, capital really ceases to be an issue. And thirdly, there's a lot of brand name related focus, which becomes very, very important, which again, unfortunately for the fintechs, if you compare them to some of the incumbent banks, let's say HSBC as an example, it's a 150-year-old bank, and here you've got fintechs, most of which are probably not even 150 weeks old. So how do you then, compete with them in terms of brand name? So I think a lot of these factors really put together make it very difficult for fintechs to scale at the pace they would really want to if they have to do it all by themselves.
Anuj, just on the point of disruption, I'm curious to get your view. I'm sure you've delved into it as part of your research into the report. With the exception of payments, what are the other areas where fintechs have actually managed to disrupt business models for large banks? Payments is obvious to all of us, but we can't think of anything else that sort of jumps out at you.
Sure. I think that's a really interesting question. And I think part of the reason for that, especially in India, is that payments is one area where we see a lot of business to consumer sort of fintechs coming out. So you've got the likes of Paytm and Freecharge and a lot of others where they directly end up catering to the end consumer. But what we've got to remember is that fintechs very often, they are operating in areas where their business model is such that they don't cater to the end customer themselves, but they provide a lot of value-added services or support or focus on very niche specific areas, which banks really need somebody to help them on. So unfortunately, the end customer doesn't see the fintech by itself, but if you look at an ICICI or an HDFC or a Yes Bank, it's possible they might be partnering or collaborating with a number of fintechs behind the scenes, but you don't see their logos when you go to the application or to the website. All you see is the bank you're banking with. But again, to answer the question, I think lending, wealth management, customer onboarding, these are some of the other areas where a lot of fintechs are doing some really disruptive behind the scenes stuff, which is really changing the game very quickly.
Sure, that's an important point that you make, that we may not know of the disruption being caused by the fintech because some of this innovation may be happening in-house or through accelerators, which I think the report talks about. Anuj, I want to get one last question in because I thought it was very interesting. You talk about the role of big tech. Can you tell us a little bit about that? So you're referring to the likes of Alibaba's and Financial, etc., large customer bases, perhaps brand, perhaps cash reserves. So are we going to now get into a phase where these big techs, as you call them, are going to make the difference?
Absolutely. So we think they are definitely bound to make a huge splash in this area. And it just seems to be a question of time. If you look at some of our eastern neighbors, if you look at China and a lot of the Southeast Asian markets, the likes of Tencent and Alibaba through Ant Financial, they've completely disrupted the payments market. In fact, so much so that Ant Financial is almost becoming a player which is, it's becoming a part of the social culture in markets like China. And even if you look at some of the other bigger technological players, the so-called GAFA, that's Google, Amazon, Facebook, and Apple. If you just look at what each one of them is doing, Google's come out with Google Pays in India and Google Pay globally. Amazon, again, Amazon Pay is beginning to gain a lot of traction in India. You've got Facebook, which through WhatsApp is beginning to make inroads in India now, or it's bound to make inroads pretty quickly. And then again, you've got Apple Pay, which at least in the West is already huge. So I think it's only a question of time before all of these big technology players, especially given the resources at disposal they've got in terms of technology, the people, the financing, it's probably just a matter of time before we see them really making a huge dent in this area.
Very interesting, Anuj. Sorry we can't extend this conversation any longer, out of time on the show, but interesting report, and great to have you on the show.
Thank you so much for joining us on Bar Lunch today.